Silver collapsed in minutes. Prices moved faster than risk systems could respond. And then something unusual happened. Trading slowed, systems paused, banks and exchanges reported technical issues at the exact moment liquidity mattered most. This is not a story about silver alone, and it is not about panic or headlines. It is about what breaks first when markets are pushed to their limits. Because when prices fall, that's normal. But when infrastructure hesitates, the question changes completely. What failed, who benefited, and what does this moment quietly reveal about the system we all rely on? The sudden collapse in silver prices did not arrive with a warning. It arrived with speed. Within hours, prices moved through levels that had taken months to build. Screens turned red. Commentators rushed to explain what had happened. Some blamed sentiment, others blamed speculation. Many focused on the number itself, as if the number alone could explain the meaning of the moment. But in complex financial systems, price is rarely the full story. Price is the surface. What matters more is how the system behaves when pressure is applied. And on this day, something beneath the surface began to show strain. Silver did not simply fall. It moved with a force that suggested urgency rather than choice. The pace of the decline pointed to forced behavior. Positions being closed not because investors wanted to exit, but because they had to. This distinction is critical. Voluntary selling reflects opinion. Forced selling reflects structure. And structure is where serious analysis begins. As prices dropped, reports emerged of delays, pauses, and technical interruptions across parts of the financial infrastructure. Metals? Exchanges experienced disruptions. Banks reported system issues. Trading slowed at precisely the moment activity should have been highest. Individually, each incident could be dismissed. Together, they formed a pattern worth examining. Silver did not simply fall. It moved with a force that suggested urgency rather than choice. The pace of the decline pointed to forced behavior, positions being closed not because investors wanted to exit, but because they had to. This distinction is critical. Voluntary selling reflects opinion. Forced selling reflects structure. And structure is where serious analysis begins. As prices dropped, reports emerged of delays, pauses, and technical interruptions across parts of the financial infrastructure. Metals, exchanges experienced disruptions. Banks reported system issues. Trading slowed at precisely the moment activity should have been highest. Individually, each incident could be dismissed. Together, they formed a pattern worth examining. This analysis does not begin with the assumption of wrongdoing. It begins with a more disciplined question. What does it mean when markets move faster than the systems designed to manage them? Financial markets today are not simple meeting places between buyers and sellers. They are highly engineered environments built on leverage, collateral, and continuous risk calculation. Every trade relies on a chain of assumptions about liquidity, counterparty strength, and system availability. During calm periods, these assumptions hold quietly in the background. During stress, they are tested all at once. Silver occupies a unique position in this architecture. It is both a financial asset and a physical commodity. It trades in futures markets, ETFs, and derivative structures, yet it also exists as inventory that must ultimately be delivered, stored, and financed. This dual nature makes silver especially sensitive to disruptions in liquidity. When prices move sharply, margin requirements change. When margin requirements change, leverage becomes unstable. And when leverage becomes unstable, forced liquidation begins. This is not theory. It is mechanical. The key insight is this. The decline itself did not create stress. The decline exposed stress that already existed. As selling accelerated, liquidity thinned. Buyers stepped back, not because they lacked interest, but because risk models demanded caution. Market makers widened spreads. Algorithms reduced exposure. The depth that normally absorbs volatility disappeared. In such moments, price stops reflecting consensus value and begins reflecting urgency. This is when systems are most vulnerable. Exchanges and banks are built to handle volume, but they are also built to protect themselves. Risk engines monitor exposure in real time. When volatility exceeds predefined thresholds, safeguards activate. Trading may slow, systems may pause, access may narrow. These responses are not errors. They are defensive mechanisms. However, defensive mechanisms come with consequences. They concentrate risk into smaller windows of time and fewer participants. They change who can act and when, and they raise a question that matters deeply to businesses and investors alike. What happens when access to markets is not guaranteed during stress? The word glitch is misleading. It implies randomness. It suggests accident. In reality, what occurred aligns closely with how tightly optimized systems behave under extreme load. Just as a power grid sheds demand to prevent collapse, financial infrastructure restricts activity to preserve solvency. The issue is not that systems reacted. The issue is how narrow the margin for error has become. Silver's decline revealed how quickly liquidity can evaporate when leverage is unwound simultaneously. It revealed how dependent price discovery has become on uninterrupted system function. And it revealed how closely connected markets, exchanges, and banks truly are. This matters beyond metals. For business leaders and capital allocators, the lesson is not about predicting the next price move. It is about understanding where fragility resides. Systems that appear robust during normal conditions may behave very differently when confidence is replaced by urgency. Events like this function as stress tests. They show which assumptions hold and which fail. The assumption that markets will always be open. The assumption that liquidity will always appear. The assumption that price alone tells the full story. None of these assumptions are guaranteed. As this analysis continues, the focus will move away from the headline and deeper into the mechanics, liquidity, leverage, infrastructure, and incentives. Because what happened to silver is not isolated. It is a case study, a signal. And signals, when understood correctly, offer an advantage, not through prediction, but through preparation. The event is not the story, the system's response is. Liquidity is often spoken about as if it were a constant. In reality, it is conditional. It exists when participants are willing to commit capital at known prices under known rules. When those conditions change, when risk becomes difficult to measure, liquidity does not decline gradually. It can vanish. This is the core mechanism behind what unfolded. Silver did not fall simply because more sellers appeared. It fell because the structure that normally absorbs selling pressure thinned rapidly. Buyers did not disappear out of fear. They stepped aside because the cost of providing liquidity rose faster than models could justify. In modern markets, liquidity is not primarily supplied by long-term investors. It is supplied by intermediaries, market makers, arbitrage desks, and algorithmic systems, whose role is to balance flow. These participants operate on narrow margins. Their commitment depends on stable volatility, predictable correlations, and reliable access to funding. When volatility spikes, these assumptions break. Margin requirements are recalculated. Collateral haircuts increase. Risk limits tighten. The same leverage that magnifies gains in calm markets accelerates exits under stress. Positions that were sensible days earlier become unacceptable within minutes. This is how liquidity cascades form. One forced sale triggers another. Prices gap lower not because value has changed, but because capacity has. Silver is particularly exposed to this dynamic. Futures markets dominate price discovery, yet settlement ultimately connects back to physical supply chains. When paper positions are unwound rapidly, the system must reconcile financial exposure with real-world constraints. This creates tension. As selling accelerates, the futures market reflects urgency. At the same time, physical markets often respond more slowly. Inventory does not vanish overnight. Demand does not collapse instantly. The disconnect between paper pricing and physical availability widens. This is not a sign of manipulation. It is a sign of mismatched time horizons. Financial markets operate in milliseconds. Physical markets operate in days, weeks, and months. When these clocks fall out of sync, price becomes noisy. Another critical element is collateral. In leveraged markets, every position rests on pledged assets. As prices move sharply, the value of that collateral changes. Margin calls follow. Participants must either post additional funds or reduce exposure. When many participants face the same constraint simultaneously, selling becomes compulsory. This is why liquidity events often feel sudden and overwhelming. They are not driven by opinion. They are driven by math, and math is indifferent to narrative. During the decline, many observers asked why prices moved so far, so fast. The more useful question is why depth was insufficient to slow the move. The answer lies in concentration. Liquidity provision has become centralized. A relatively small group of institutions provides a large share of day-to-day market depth. This efficiency lowers costs during stable periods, but it also increases vulnerability. When these providers step back at the same time, gaps form. Those gaps are where prices fall through levels that once seemed secure. This phenomenon is not unique to metals. It has appeared in equity markets, bond markets, and currencies. What makes silver notable is its size. Compared to major equity indices, the silver market is small. It does not require enormous capital flows to move it dramatically. This magnifies every structural weakness. Liquidity is not just about volume. It is about willingness, and willingness is governed by incentives. When risk rises, incentives change. Market makers are not obligated to stand in front of a falling market indefinitely. Their mandate is survival, not stabilization. When models signal danger, they retreat. This retreat can look like abandonment. In reality, it is rational behavior within existing rules. The question for serious observers is not whether this behavior is fair, but whether the system is resilient. As liquidity contracted, the market entered a feedback loop. Lower prices increased margin stress. Margin stress forced more selling. Selling further reduced liquidity. Each step reinforced the next. This is why the decline felt disconnected from fundamentals. It was not a debate about silver's long-term role or demand. It was a short-term reckoning with leverage. Understanding this distinction matters. It separates signal from noise. Liquidity events also test infrastructure. As order flow surges and prices move rapidly, systems designed for normal conditions face abnormal load. Risk engines must recalculate exposures in real time. Clearing systems must ensure that obligations can be met. This is where operational strain appears. Not because systems are poorly designed, but because they are designed with thresholds. When those thresholds are crossed, protective measures activate. Liquidity stress and infrastructure stress are linked. One amplifies the other. For business leaders and entrepreneurs, the relevance is direct. Liquidity determines access to capital, to hedging, to exit. When liquidity is abundant, options multiply. When it contracts, choices narrow. Events like this reveal where dependence has quietly accumulated. Dependence on leverage, dependence on continuous access, dependence on assumptions that hold only in calm markets. As the analysis moves forward, the focus will shift from liquidity itself to the systems tasked with managing it. Because when liquidity becomes scarce, infrastructure becomes the bottleneck. And bottlenecks, once revealed, change behavior long after prices recover. Liquidity is not the background of the market. It is the market. Financial markets are often described as abstract spaces, screens, charts, numbers moving at speed. In reality, they rest on physical and digital infrastructure that must function continuously for prices to mean anything at all. Exchanges, clearinghouses, and banks are not passive conduits. They are active risk managers. Their systems exist to ensure that trades can be honored, collateral can be verified, and obligations can be settled. Under normal conditions, this machinery operates quietly in the background. Under stress, it moves to the foreground. During the silver collapse, attention shifted from price to access. Reports of delays, pauses, and system interruptions began to surface. These moments are often misunderstood. They are not random failures. They are points where the speed of markets collides with the limits of infrastructure. Modern exchanges rely on continuous recalculation of exposure. Every price change alters margin requirements, counterparty risk, and net positions across thousands of participants. When volatility accelerates, these calculations multiply in complexity and urgency. At a certain point, systems must choose between speed and safety. Safety usually wins. This is not unique to metals. Similar dynamics have appeared during equity crashes, bond market dislocations, and currency shocks. What distinguishes metals is the link between financial contracts and physical settlement. Futures positions may be closed instantly, but the metal itself cannot move at the same pace. This mismatch creates operational strain. As prices fall, clearing systems must ensure that losses are covered. Banks must confirm that collateral remains sufficient. Exchanges must verify that their members can meet obligations. Each step introduces friction. Friction slows markets. The language used to describe these moments matters. Calling them glitches suggests malfunction. A more accurate description is protective intervention. Systems are designed to reduce activity when risk becomes difficult to quantify. From the perspective of the system, slowing or pausing activity is a rational response. From the perspective of participants, it can feel like uncertainty or loss of control. Both can be true at the same time. There's a deeper issue beneath these events: optimization. Over the past decades, financial infrastructure has been optimized for efficiency, faster execution, lower costs, tighter spreads. These improvements benefit markets during stable periods. They also reduce slack, the excess capacity that absorbs shocks. When slack is removed, systems become more sensitive to extremes. The silver event demonstrated this sensitivity. Activity surged, volatility spiked, risk models reacted, infrastructure responded by constraining flow. This sequence reveals a structural trade-off that is often overlooked. Efficiency and resilience are not the same thing. A highly efficient system performs exceptionally well within expected parameters. A resilient system performs adequately when those parameters are exceeded. Markets increasingly favor efficiency. That preference has consequences. Banks play a critical role in this chain. They provide funding, clearing services, and credit lines that support trading activity. When volatility rises, banks reassess exposure. They may tighten limits, demand additional collateral, or temporarily restrict certain activities. These decisions are not coordinated conspiracies. They are parallel responses to shared risk signals. However, parallel responses can amplify outcomes. When multiple institutions reduce exposure simultaneously, liquidity contracts further. Infrastructure becomes more restrictive. Access narrows at the precise moment when participants seek flexibility. This is where perception diverges from reality. To observers, it may appear that systems are failing. In fact, systems are doing exactly what they were designed to do: prioritize solvency over continuity. The cost of this prioritization is uneven access. Those with stronger balance sheets and fewer constraints retain optionality. Those dependent on leverage or constant liquidity face hard limits. This dynamic quietly shapes outcomes. For entrepreneurs and business leaders, the lesson extends beyond metals. It speaks to the importance of understanding where operational dependencies exist. Many strategies assume uninterrupted access to markets, credit, or settlement systems. Events like this challenge that assumption. They show that access is conditional. It depends on volatility, counterparty confidence, and system capacity. When infrastructure becomes the constraint, price signals lose clarity. Markets no longer reflect pure supply and demand. They reflect which participants can still act. This is not a moral judgment. It is an operational reality. The silver episode offers a clear example. As infrastructure strained, price discovery compressed into thinner channels. Small flows had outsized impact. Volatility fed on itself. Once pressure eased, systems stabilized. Prices rebounded. But the memory of constraint remains. These moments influence behavior long after the charts recover. Participants adjust risk models. Institutions revise limits. Regulators review procedures. Each adjustment subtly alters the market's future response to stress. Infrastructure does not forget. As the analysis progresses, attention must turn to implications, not predictions, but strategic considerations, because understanding how and why infrastructure constrains markets under stress offers a powerful lens. It reveals where flexibility exists. It reveals where fragility hides. And it reveals how capital behaves when efficiency gives way to survival. When price moves faster than infrastructure can follow, it is no longer just a market event. It is a system test. When volatility fades and prices stabilize, the temptation is to move on. Markets recover. Headlines shift. Attention disperses. But experienced decision makers understand that the most important effects of stress events appear after the noise subsides. They appear in behavior. The silver collapse and the strain observed across exchanges and banks was not an endpoint. It was a diagnostic moment, one that revealed how capital, infrastructure, and incentives interact when confidence is replaced by urgency. The first implication is about access. In theory, markets are open systems. In practice, access is conditional. It depends on balance sheet strength, collateral quality, and operational readiness. During stress, those conditions tighten. Participants discover, often for the first time, where their real limits lie. This matters for businesses that rely on hedging, financing, or liquidity at specific moments. Strategies built on the assumption of continuous access must account for the possibility that access narrows precisely when it is most valuable. The second implication concerns leverage. Leverage is efficient in stable environments. It reduces capital costs and increases returns. It also creates nonlinear risk. When volatility rises, leverage does not merely amplify losses. It forces timing. Decisions that could be deferred become immediate. The silver event demonstrated how quickly leveraged exposure can transition from asset to liability. This dynamic applies broadly to commodities, equities, credit, and even operating businesses dependent on short-term funding. The third implication is more subtle: the separation between price and trust. Price is visible, trust is not. During the decline, prices moved sharply. At the same time, physical markets, settlement processes, and long-term demand did not disappear. This divergence highlights a reality often ignored in calm periods. Price is a function of liquidity and access, not just value. For serious capital allocators, this reinforces the need to distinguish between volatility-driven price signals and structural changes in demand or supply. Not every price move conveys new information. Some reveal temporary imbalance. Another lasting effect lies in institutional memory. Exchanges, banks, and clearinghouses adjust after stress events. Risk parameters are reviewed. Margin models are refined. Operational safeguards are reassessed. These changes alter how the system will respond next time. Participants also adjust. Some reduce leverage permanently. Others diversify access points. Many reassess which assumptions they treated as fixed. These adaptations are quiet, but they accumulate. For entrepreneurs and business leaders, the broader lesson extends beyond metals or markets. It speaks to resilience. Systems optimized solely for efficiency perform well until they do not. Systems designed with redundancy and flexibility sacrifice some efficiency, but endure stress with less disruption. Capital behaves the same way. Liquidity, credit lines, supplier relationships, and customer demand all respond differently under pressure. Events like this encourage a shift in mindset, from maximizing output under ideal conditions to sustaining operation under imperfect ones. Slightly slower emphasis. This is not pessimism. It is realism. The silver episode also underscores the importance of time horizons. Short-term volatility often dominates attention. Long-term structural trends unfold quietly. When stress compresses activity into narrow windows, it can obscure the difference. Those who confuse forced selling with fundamental change risk acting on noise. Those who recognize the mechanics can remain patient. This distinction is not about predicting prices, it is about interpreting signals correctly. Finally, there's an implication for governance and oversight. Markets depend on trust, not only in counterparties, but in infrastructure. Transparency during stress matters. Communication matters. Clarity about rules and responses matters. When systems hesitate without explanation, uncertainty grows. When participants understand why safeguards activate, confidence returns more quickly. This balance will shape future market stability. The story of silver's collapse is not a story of failure. It is a story of exposure. It exposed how tightly liquidity, leverage, and infrastructure are intertwined. It exposed how quickly efficiency can give way to constraint. And it exposed how critical access and preparation are when conditions shift. For those willing to study these moments, the reward is not foresight, but readiness. Markets will remain volatile. Systems will continue to be tested. The next event will look different in detail, but familiar in structure. Those who understand the structure will respond differently. The most important question is not what silver will do next. It is how prepared the system and its participants are for stress. And that answer is shaped not in moments of panic, but in moments of understanding.